Every nation wants to be the world's banker. The prestige, the power, the ability to borrow in your own currency while the rest of the planet scrambles for dollars. It sounds like a gift from the economic gods. But history whispers a darker truth. Reserve currency status is not a crown. It's a trap. And every empire that wore it eventually discovered the same brutal lesson. The privilege of printing the world's money comes with a price tag that compounds silently across generations. Until one day the bill arrives and the empire that thought it was invincible finds itself suffocating under debts it can never repay. This is not speculation. This is pattern recognition. The Dutch guilder dominated global trade in the 1600s. The British pound ruled the 19th century. The US dollar has reigned since 1944, and every single one of them followed the same trajectory: dominance, overextension, structural decay, and eventual displacement. The mechanics change across centuries, but the outcome is always the same. Reserve currency status doesn't protect you from collapse. It guarantees it. Let's begin with what most people misunderstand about reserve currencies. They imagine it as a mark of strength, proof that the world trusts your economy above all others. That's true at first, but trust is not static. It is a loan that must be constantly renewed, and the terms of that loan are never in your favor. Because once your currency becomes the global standard, you are no longer in control of your own monetary policy. You are a servant to the world's liquidity needs. Every trade imbalance, every capital flow, every foreign central bank's decision to hoard or dump your bonds. These are forces you cannot command. Your economy becomes the shock absorber for everyone else's crises, and eventually that role breaks you. Let's travel back to the Dutch Golden Age. In the early 1600s, Amsterdam was the financial capital of the world. The Dutch East India Company was the largest corporation ever created, worth more in today's terms than Apple, Microsoft, and Google combined. Dutch ships controlled the spice trade, the slave trade, the textile routes, and at the heart of this empire was the guilder, a currency so trusted that merchants from Lisbon to Jakarta preferred it over their own money. But here's what the history books often skip. The Dutch didn't just get rich from trade. They got rich from debt. Amsterdam pioneered the modern bond market, allowing the government to borrow at extraordinarily low rates because the world believed Dutch promises were ironclad. This was revolutionary. Suddenly, the state could finance wars, fleets, and infrastructure without immediate taxation. It could live beyond its means indefinitely, so long as confidence held. And confidence did hold for a while, but the trap was already closing. To maintain reserve currency status, the Dutch had to run persistent trade surpluses. Foreign merchants needed to acquire guilders to settle accounts, which meant the Dutch economy had to export more than it imported. This created internal imbalances. Wages rose, making Dutch goods expensive. Competitors in England and France began undercutting Amsterdam's dominance. The Dutch responded by borrowing more, using debt to subsidize their military and trading networks. It worked in the short term. In the long term, it hollowed them out. By the late 1700s, the guilder was still accepted globally, but the Dutch economy was fragile. When the Fourth Anglo-Dutch War broke out in 1780, Britain blockaded Dutch trade routes. Revenue collapsed. Debt payments ballooned. And suddenly, the world's most trusted currency was backed by an economy that could no longer generate the wealth to support it. The guilder didn't disappear overnight. It faded slowly, losing relevance as British sterling rose to replace it. The lesson was clear. Reserve currency status is a game of borrowed time. The lesson was clear. Reserve currency status is a game of borrowed time. You can the reckoning, but you cannot escape it. What killed the Dutch wasn't military defeat alone. It was the structural contradiction of being the world's lender and the world's borrower simultaneously. To keep the guilder desirable, they had to keep lending to foreign governments and merchants. But lending abroad meant exporting capital, which drained domestic investment. The more they lent, the weaker their own productive base became. Eventually, the system consumed itself. Fast forward to the 19th century. Britain inherited the reserve currency mantle and wore it with imperial arrogance. Sterling was the language of global commerce. Every shipment of cotton, every barrel of oil, every ton of coal was priced in pounds. British banks financed railroads in Argentina, mines in South Africa, factories in India. The sun never set on the British Empire, and neither did the pound. But the mechanics of reserve currency dominance were already warping Britain's economy in ways contemporaries did and fully understand. To maintain sterling's global role, Britain had to run a persistent current account surplus. This meant exporting more goods and capital than it imported. On paper, it looked like strength. In reality, it was extractive. Britain was funneling wealth from its colonies and trading partners back to London, creating the illusion of prosperity while the industrial base slowly eroded. Here's the paradox. The more successful Britain was at exporting capital, the weaker its domestic economy became. Money flowed to Argentina to build railroads that would compete with British manufacturers. It flowed to India to develop textile mills that undercut Lancashire. It flowed everywhere except into modernizing Britain's own infrastructure. By the early 20th century, Britain was still rich on paper, but its factories were aging, its workers underpaid, and its competitors, especially Germany and the United States, were overtaking it in industrial output. World War I shattered the illusion. Britain borrowed massively from the United States to finance the war effort. By 1918, Britain owed more to America than it planet could ever hope to repay through trade. Yet sterling remained the global reserve currency for another 3 decades, not because Britain was strong, because the world needed stability and no alternative had emerged. The pound limped through the 1920s, survived the Great Depression barely, and finally collapsed during World War II, when Britain again borrowed beyond its capacity. The Bretton Woods Conference in 1944 formalized what markets already knew. The dollar, not the pound, was now the world's currency. Britain had spent a century financing the world's growth and ended up bankrupt. The reserve currency trap had claimed its second victim. Now we arrive at the present. The US dollar has been the world's reserve currency since 1944, and for most of that time, Americans have treated it as a divine right. But the same structural forces that destroyed the guilder and the pound are already at work. The dollar's dominance is not a sign of strength, it is a symptom of the trap closing. Here's how it works. Because the dollar is the global reserve currency. Foreign governments, corporations, and central banks need to hold dollars to conduct trade. This creates constant demand for US Treasury bonds, which allows the American government to borrow at artificially low interest rates. Sounds like a gift, right? But there's a cost. To supply the world with dollars, the United States must run persistent trade deficits. It has to import more than it exports, sending dollars abroad in exchange for goods. This flood of cheap imports keeps American inflation low and consumers happy, but it also destroys the domestic manufacturing base. Factories close because they cannot compete with subsidized foreign production. Wages stagnate because the labor market is undercut by global competition. The tire regions, the Rust Belt, Appalachia, the rural South, are hollowed out. Meanwhile, the financial sector grows grotesquely large because managing global dollar flows is enormously profitable. Wall Street thrives while Main Street decays. The economy becomes unbalanced. Too much finance, too little production, and because the government can borrow so cheaply, it has no incentive to control spending. Debt accumulates year after year, used not for productive investment, but for consumption, subsidies, and military expenditures that generate no economic return. This is the trap. The dollar's reserve status allows America to live beyond its means indefinitely, but only by sacrificing its long-term productive capacity. The country that prints the world's money becomes the world's consumer of last resort, not its manufacturer. And when that role inevitably ends, the fall is catastrophic. We are already seeing the early stages of this collapse. China is building an alternative payment system to bypass the dollar. Russia, Iran, and other nations are trading in local currencies. Even traditional U.S. allies like Saudi Arabia are exploring non-dollar oil transactions. The world is slowly, quietly, moving away from dollar dependence. And when that shift accelerates, the United States will face a reckoning that makes 2008 look like a minor correction. Reserve currency status doesn't just distort economies, it distorts politics. Because the country that issues the global currency can borrow almost without limit, its government is insulated from the normal discipline of fiscal reality. Deficits don't matter. Debt doesn't matter. The printing press is always there to cover the gap. This creates a dangerous dynamic. Politicians can promise everything, deliver little, and never pay the price. Infrastructure crumbles because maintenance is boring and doesn't win votes. Education stagnates because real reform is hard. Healthcare costs spiral because the system is captured by interest groups. But none of this triggers a crisis because the government can always borrow more. The bond market never revolts because foreign central banks have no choice but to keep buying treasuries. They need dollars, and treasuries are the only safe place to park them. But this arrangement cannot last forever. Every reserve currency in history has eventually faced a moment when the world stops believing. It happened to the Dutch when their trade empire collapsed. It happened to the British when they bankrupted themselves in 2 world wars. And it will happen to the United States when the rest of the world concludes that holding dollars is a losing bet. What triggers that moment? Sometimes it's a military defeat, sometimes it's a financial crisis, sometimes it's simply the emergence of a credible alternative. But the mechanism is always the same. Confidence breaks, capital flees, and the country that thought it could borrow forever discovers that it cannot. Here's the question that should haunt every American. If reserve currency status is a trap that eventually destroys economies, why does the US government cling to it so desperately? Why does every administration, regardless of party, defend the dollar's global role as if it were a matter of national survival? The answer is simple: because certain groups profit enormously from the arrangement, even as the country as a whole declines. Wall Street profits because it intermediates the global flow of dollars. The financial sector collects fees, spreads, and commissions on every transaction. Defense contractors profit because the dollar's reserve status allows the US to maintain a global military presence without immediate fiscal pain. Multinational corporations profit because they can borrow cheaply in dollars and invest anywhere in the world. But ordinary Americans do not profit. They pay the cost in lost jobs, stagnant wages, crumbling infrastructure, and a political system that no longer responds to their needs. The reserve currency trap is a wealth transfer mechanism, moving resources from the productive economy to the financial economy, from labor to capital, from the future to the present. This is not a conspiracy. It is simply the logic of the system. Reserve currency status creates winners and losers, and the winners are powerful enough to keep the game going even as the country sinks deeper into structural decay. History tells us what comes next. The reserve currency does not collapse suddenly in a single dramatic crash. It fades slowly, losing relevance at the margins until one day the world wakes up and realizes it no longer needs to hold dollars. Trade shifts to other currencies. Central banks diversify their reserves. The demand for U.S. treasuries evaporates. When that happens, interest rates will spike. The U.S. government will no longer be able to borrow at 3% or 4%. It will have to offer 7%, 10%, perhaps more. Debt service costs will consume an ever larger share of the federal budget, crowding out everything else. Social Security, Medicare, defense, infrastructure, all of it will be on the chopping block. But cutting spending will not be enough. The debt is already too large. The only way out will be inflation, lots of it. The Federal Reserve will monetize the debt, printing dollars to cover obligations the government can no longer finance through borrowing. Prices will rise, savings will be destroyed, and the American middle class will discover what the British middle class learned in the 1970s. Reserve currency status is a privilege that ends in ruin, and the truly bitter irony. The countries that replace the dollar as the global reserve will walk straight into the same trap. China, if it succeeds in making the yuan a reserve currency, will face the same contradictions. It will have to run trade deficits, export capital, and sacrifice its domestic economy to service the world's liquidity needs. The trap is not uniquely American. It is structural, and no one escapes it. So what do you do with this knowledge? First, understand that the system is not designed to protect you. Reserve currency privilege flows to financial elites, not to ordinary savers. Your dollars are being quietly devalued to finance a global system you do not control and do not benefit from. Second, recognize that the endgame is already in motion. The dollar's dominance is eroding. It may take years or decades, but the direction is clear, and the shift accelerates. Those holding dollar-denominated assets will be crushed. Third, diversify. Not just into other currencies, though that helps. Into real assets, land, productive businesses, commodities, skills that retain value when paper currencies collapse. The survivors of reserve currency transitions are never the ones holding the old currency. They are the ones holding what cannot be printed. And finally, understand that this is not just an economic story. It is a story about power, about how nations rise by creating trust and fall by abusing it. The reserve currency trap is the price of empire, and empires always pay. Reserve currency status is not a reward. It is a burden disguised as privilege. It allows a nation to live beyond its means for a generation, maybe two, but the cost is always the same. The slow erosion of productive capacity, the accumulation of unpayable debts, and the eventual collapse of the very system that seems so strong. The Dutch learned this. The British learned this. And the Americans are learning it now. The trap has closed before, and it will close again. The only question is whether you will recognize it in time. History doesn't repeat, but if you ignore it, it will crush you all the same.